Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who've cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Well, welcome everybody. We've got a fantastic episode of Build a Business Worth Buying. I'm joined by Maia Benson. If you don't know Maia, you really should. She is a very seasoned startup operator and venture advisor with nearly 2 decades of operating experience. She's worked with early stage companies, helping people find those successful outcomes that can be so elusive. Maia's worn multiple hats across operations, growth, investment roles, and she's developed a really sharp lens for what separates a high potential founder from the rest. And so I'm really looking forward to hearing her insight into what makes a startup fundable and acquirable. Her work includes advising some of the most ambitious entrepreneurs in commerce, logistics, and SaaS. She's known for a no-nonsense approach and really a no-nonsense founder-first approach is what I should say. She has had a front row seat to one of the most significant strategic acquisitions in e-commerce history. This was Shopify's decision around building or buying their fulfillment network, so Shopify Fulfillment. And this is really something that, from what I can tell, has really sharpened her thinking about how companies evaluate infrastructure investments and if it's something they should build or buy, and how do you go about that vertical integration. Currently, Maia works as the Chief Business Officer for FlavorCloud, which helps brands expand internationally. So today, Maia helps early stage companies think bigger, move faster, and really maximize optionality. And so, especially when it comes to exit. So Maia, thank you so much for being on the program.
Aaron, thanks so much for having me. And wow, what a wonderful introduction and so thoughtfully outlined. So thank you for that.
Of course. Well, you make it easy when you've accomplished a lot. I want to kind of dive in and get started. So your career has taken you all over the startup ecosystem. What people or places have taught you the most about what it means to actually build a business?
You know, I got lucky in a way, Aaron. So my career, chapter one of my career started out in Silicon Valley during dot-com boom one. So the late 90s to the early 2000s. And that was incredibly formative for me from the following perspective. For about 6 of those 8 years, I worked for International Data Corporation, which is a big tech market research firm. And my remit was to help venture-backed, so newly venture-backed or wanted to be venture-backed founders buy market research data and their estimation to find product to market fit. And so that first principles premise of brilliant engineers building next generation technology and coming to a third-party data company to say, hey, you guys know a lot about the market. If I can buy your data, I can find out who my customers will be. And why that was so formative to me in terms of understanding entrepreneurs and what makes a successful entrepreneur is I didn't know much about the world at that point in time, but I knew there was something really broken with the ask, right? So software is a bunch of ones and zeros. It's highly disposable. And why don't you just ask your customers what they want or your prospective customers what they want, right? Why come to a third-party market research company, which was awesome and amazing and had great data for insights and validation from a research standpoint, but couldn't tell you necessarily who was going to buy your exact technology and your exact product. And so really, I kind of fell backwards into this entrepreneurial thing with the insight of don't build something and then go try and find a market, right? Work with the market, understand the market, have the market rip out of you the technology that they need to solve their problems. And so I still leverage that as a core anchor, both as an investor and a builder operator, to really deeply stay hyper connected to the market, hyper connected to the evolving problems in the market at a first principles level, because technology at the end of the day is a how, it's not a what, right? So we want to build great products and leverage tech to build great products to serve real business needs. So that's the core and my center of gravity of both my professional investor lens as well as my builder lens.
That's really insightful. I want to go a little bit deeper there because there may be companies that are pre-launch, right? And they don't yet have customers, right?
Yep.
And you may also have companies that want to be doing something different. And so the customers that they have right now may not be the ones that they necessarily
Right.
aspire to. So how
Yep.
would you help them go out and say, like, let's actually find out what's going on in the market?
Yeah, you have to have access or create access. So the first principle is not going to change, which is you have to talk to your will-be customers. Even, they're brand new, you don't know them, all good. You have to go understand their market pain deeply. And so the challenge becomes, how do you get access to that pain, right? How do you get access to that problem? And there's a couple great ways to do it. Like, one, learn about their business. There's a lot you can read online or in the planet, or talk to people that surround that ecosystem to understand what the first principles problems are of these companies. Also, public companies put a lot of great information out there publicly, right, in their filings. So get smart as much as you can on the pain you can read publicly, and then that can be a point of access to walk you in. And then the other obvious point, I mentioned it, is just work your network. Ask for help, work your network to get into the prospective customers, to earn a little bit of trust, to learn about their pain. Engineers have an awesome skill set with hands-on keyboards. So the other play is build a small prototype, build something as a hook, and then literally just say, can I have 20 minutes of your time? I understand your pain might be X. Can I just show you where I'm going, and ask for help? I think implicit in being a market-focused, obsessed entrepreneur is a really deep vein of asking for help.
Yeah, and it's gotten so easy to have prototypes these days. I mean, that might have been more difficult even 5 years ago, but today,
Yes,
I mean, you can just in an afternoon create something that's actually pretty good.
100%.
Yeah, that's a fun pastime for
Gen
me.
AI is even taking that to the next level,
For
right?
sure, for
So
sure.
yeah.
I'm interested too because you went through .com 1, you went through the
Mm,
recession,
mm,
.com 2, and now we're in the,
mm.
COVID. How has the definition of success changed for founders over your career?
That's such a great question. How is the definition of success changed? I think that um, uh, dot-com boom one had a lot more exits for a lot more companies. So it was a little bit more of a democratized, 1,000 entrepreneurs won and were able to exit
Hmm.
during dot-com boom one. I think what we're seeing with dot-com boom two is more capital went into fewer companies. So bigger bets were made on fewer companies. And so those cons had basically outsized investment and outsized returns. Now, offline in the world that we're living in, we're kind of seeing some of that start to collapse. Ergo, the IPO market has pulled away, and it's making companies like Stripe or Flexport have to wait a little bit longer to go public. But living through birth one is a lot of entrepreneurs raise capital, and I think at a more broad scale, we're able to have some sort of exit versus what you and I are living through post .com boom right now. Number two now.
Gotcha. I want to kind of zero in on your investment experience. And so when you first meet a founder, obviously first impressions are very important. You're getting assessment of, is this someone that you believe in, that you want to put money into? What signals tell you that the person you're talking to might actually be able to exit their business one day versus someone who's just really good at playing startup?
So I will preface, Foreign Ventures, we focus on pre-seed, seed, B2B SaaS investments. So we are architected to really be the first check-in.
Hmm.
So I think that's just a first principle. At that first check-in level, you basically have 3 or 4 tenants that exist to make an investment decision on. Number one, who's the founder? Have they ever done anything like this before, right? So have they had a build a business adventure before? Are they a first-time founder? Just who are they and what's their profile? Also, if they haven't done this, have they built stuff within or grown stuff within other organizations, right? So I think that's one big thing. I think the second big thing is, do they have that market obsessed orientation? Have they been in market talking to their prospective customers? Have they built a prototype? Do they have any early signs of proof that the market wants what they got, right? Or have they been in a corner building code and saying, now I think I want to bring my beautiful baby to market, and everybody's just going to want it and love it. So I think having that market obsession, rooting and anchoring in solving real world market problems, and any early signs of proof is another big thing we're looking for. And then I'd say lastly, in the early stage game, you are building, you are working with and for customers, ideally in those early stages. And I think we also look for, can they attract talent, that basically works for free to help them prove out some early proof and product to market fit. So I think those are the three things. Implicit and underscored all of that. I take this for granted many times, but we're also just looking for, do they have the horsepower to literally live through years of testing and learning their way to success? So basically, are they comfortable with fast failure? And how have they learned or proven that throughout their experience?
Yeah, makes a lot of sense. I'm sure, like you, I've met a lot of really smart people who had really good ideas that weren't really interested in building a business that they were going to sell one day. They took so much personal satisfaction in being a founder, right? Being able to speak on a panel or to have a podcast or to raise a little bit of money and things like that. And I found that it's a very different type of founder that is like, no, like, this is not my identity. This is what I'm doing right now. I'm going to build this, and the goal is 3 to 5 years. I'm going to exit and kind of go from there. As an investor, do you stay away from those lifestyle type of founders, or is it kind of one of these assumptions that, well, eventually we'll get them to come around and they'll be able to exit?
I don't think we're at all interested in lifestyle founders, right? So the folks that are the loudest in the media, the loudest on social, like to your point, their identity is being a founder. I don't think that's what we are at all looking for or optimizing for. We are looking for genuine business builders. That said, exits get exited to a myriad of buyers, right? There's not a single buyer profile out there that would be ubiquitous for every type of tech or every type of founder, right? So at the end of the day, VCs kind of bet on an exit strategy. And that exit strategy could be a buyer for based on, like, this is unbelievably cutting edge tech, right? So like, this is going to be an ingredient or a core muscle for a company. We're seeing this with like large language models right now, right? In the future. So that could be a type of exit. Another type of exit is somebody's going to want to buy this revenue, right? Another type of exit is somebody's going to want to buy this margin. So the point I'm making is not every company born is looking at potentially the same type of buyer and therefore exit strategy. So as investors, we kind of have buckets in our mind, which is, we're betting that this could be a 100-year plus company, right? That could be a thing, right? With, great revenue and great profit margins. This could be a, 5 to 7 to 10-year company because somebody's going to want to buy the tech and the founders. So we have, portfolio approach to managing that risk and really betting on our experience of where we see exits. Well, Aaron, that the other part of this whole investment game is just literally luck and timing, right? So the other thing we're betting on is our ability to have seen the world's motions over decades and understand when we think different profiles of companies in our portfolio could exit, right? And what's difficult for VCs right now that you and I are living through is the timing on the market with the cost of capital exploding 2 years ago and the IPO market right now kind of really locking up or locking down, meaning it's not friendly, is it's hurting a lot of investors that made pretty good bets. They've just had the market headwinds come in pretty hard.
Yeah, I really like how you frame the exit outcome. I had always heard people talk like, oh, you're going to IPO, you'll get acquired by a strategic or a PE. But I've never heard someone talk about what exactly is that they're buying from a financial point of view, the revenue, the profit margin, the team, the tech, things like that. When talk to me a little bit about how you go about making that thesis when you're evaluating an investment. Is it something where, okay, yes, you've met the founder, you've got the idea. How much modeling or views are you doing to say, okay, this is probably how it's going to go. This is probably how it's going to be sold. And how often is that match reality?
I think we focus a lot on growing our expertise from markets, right? So I think we want to become and continually become, better said, we're all constant learners and the markets are always changing. But you want to become an expert on the market. So as investors, you asked about kind of the profile that we look for from the founder perspective, which is awesome. The other thing that we look at is how big's the market and what's happening with those market dynamics, like period, hard stop, right? And so becoming an expert on a logistics vertical, a healthcare vertical, whatever your vertical might be, then helps you understand where the gaps are in that market. Is there a massive mechanism or turn of the crank on technology, right? So that's one profile. If the answer is yes, then that's a profile of company you want to look for, right? Like there's a material replatform, there's a material crank that's been turned, new data access has been unlocked for whatever reason in a market, therefore can be capitalized on. You get the point. The other thing that could be true is that market needs a massive problem solved that just has not been able to have been solved. And so what's the 100-year company that could come in and solve that? So the answer to that question is, as investors, we want really $1 billion plus market sizes, because at the end of the day, you're betting on one of your portfolio companies taking 5, maybe 10% share, right? So that's your exit math. And your asynchronous information advantage is candidly your ability to understand the state of that market kind of better than the rest of the world. So really those are kind of key ingredients or gears that investors invest in, is really that market intelligence, and therefore how they manage a portfolio of risks, these variable companies that they invest in, to inject into that market's problems.
How much as an investor are you trying to qualify if the idea is good enough, right, to be funded, versus good enough to provide a return to investors? Like, is there a difference in that calculus? And do you ever come across deals that, like that would make sense to fund, but I just don't see the return here?
So there's another important ingredient that I didn't highlight when we talked about the founder profile that addresses this question, which is we invest in founders that also are so market obsessed that as they're going through their proving that what their idea is what the market needs, if it isn't, they're still listening and can pivot to what is, right? So I guess my point is, in the early stage pre-seed seed investor land, we're in that proof stage. So there's not a lot of business case math I can do, right? Because there's nothing on the pricing side that's been proven. There's nothing on the go-to-market side that's been proven. This is literally, is it a big market? Can this founder have something about who they are, their experiences that's going to uniquely capitalize on it? Can they get access to learning what these problems are? And then candidly, are they the type that can listen acutely? And if they need to pivot, can pivot, right? That is so common in the pre-seed seed space, is that pivot. So we're not yet at the business case land. One of the fortunate things I in my career learned was I was building first ever businesses within big corporate America. So on one hand, I got anchored in build a business case, right? And I'm an MBA, right? So that wasn't a foreign concept. So I had to do 3 and 5 year math with a bunch of assumptions and get very comfortable and smart about building assumptions, right? So I'm grateful that I have that as an anchor, but just at the pre-seed seed level, that value, none of the business cases that we built for any of the businesses within big corporate were perfectly done nor realized against what the V1 was, right? So it's much more in these early stage investment opportunities is, do you have a founder that can acutely listen to the market's problems? And if their hook, what they think the problem is, and the tech they're building against that hook isn't resonating, or isn't resonating beyond a certain monetary threshold. I just had an awesome founder that was building a fantastic product for billing and invoicing for 3PLs. She did it for a year. It's a real need. It's a real market need. But the value extrapolation, so the trade on what she could get for cash, was not as high as one would have assumed, or the hypothesis was. So then it's like, yeah, there's product to fit need here, but after a year, what we've proven is the return on that, what somebody's willing to pay for that, is lower than she wanted to have, as in terms of building a venture scale business. So pivoting, learning, staying close in that early stage is absolutely critical. And again, early stage investors aren't looking at perfect business cases or candidly much assumptions. In fact, if you're a founder listening to this and you go into an investor pre-seed seed with a pro forma that you've spent a lot of time on and built out, you're probably going to get some healthy skepticism, and no one's going to really read it.
You can make a spreadsheet say anything.
You nailed it. You absolutely nailed it.
Yeah, you've kind of talked about this as well, but maybe it'd just be helpful for people to hear, what is the success criteria for a seed stage investor investment? And then how's that different from the A or the B to the exit? Because kind of what I'm hearing is that, really the purpose is, when you're doing pre-seed or seed stage investing, you're really inviting somebody to go on a learning journey with you. And it's a question of like, all right, we're going to fund this a little bit. We're going to build something. We're going to get a sense of if this market is what we think it's going to be. And we're going to figure out, like you said, is there value extraction available? How does that mindset need to change when you start to be in the business case level?
Yeah. So there's kind of a ladder that I can share as a reference point, period. I will also say, if everybody's keeping up with the latest pitch book data, the seed investment series is now getting higher than average, if you will, investment in it, meaning the money, the checks cut to seed investors. It used to be kind of between $2 and $10 million. Now I'm seeing more like 6 to 12. So that seed investment level has come literally, candidly, a little closer to A. So there's some changing dynamics in what early stage.
And also, I mean, I'm hearing from a lot of founders, like, they want to see a profitable business. They want to see recurring things. And so the current moment in venture is such that people want you to de-risk the business,
yes,
in more of a sense than I think traditionally we'd have.
Yes. And I think at a seed and A stage, I think optimizing for break even or profitability is really, really very early, right? So these are still the days where you're cutting your teeth and spending money to learn faster and fail faster. I think once you get to Series B and up, like we're seeing a lot of, like, can you at least get to break even or show a path to that, right? So I agree with you. A lot of investors are looking to de-risk. I would just caution founders, like, if you're growing, keep the gas on growing. The rule of 40 plus still really, really applies. Okay. So with that said, in order to raise an A round, you need $1 million of annual revenue. So that's your bench. In order to raise a seed round, you ideally need about $250K of revenue. Pre-seed is maybe $100K, $50K, just some sign of life that people are willing to exchange money for the value you have. Those are general ladder guidelines. Are they hard and fast? No way, right? So depending upon who you are and your profile and where you came from, I've got several friends that have just raised seeds out of the gate on a couple slides. So that still definitely exists, but they've also are, 2, 3, 4 X or times proven founders, right? So that's over here on this hyper extreme. And then I've seen candidly other founders that have 500K already of revenue coming in the door, banging hard to raise a seed round, right? So they've overachieved on the cash side. And those founders tend to be less more underrepresented, not having really kind of expert partners in crime to help them navigate through the fundraising. So anyway, the guidelines are 250 going into seed, $1 million going into A. Those are general guidelines, but I can't stress enough, we're now seeing seed rounds get more and more capitalized early on.
But still having those basic revenue thresholds is the check size has just gotten bigger.
Yes and no, right? Like, again, I have 2 friends and founders that have just raised seeds on just a little bit of market proof. So again, it depends on where you sit in that spectrum in terms of, proven success being an exited founder versus being a brand new founder. Sadly, in venture capital, and for America, candidly, is the access to capital. Being a founder that knows how to even engage with VCs is still a real opportunity for our country, meaning there's plenty of amazing founders working their tails off, building really great market-focused, problem-focused companies that just don't have the access to venture capital or and even know how to approach it. So one thing I'm proud of at Forum is we work really hard to democratize all of that so we can welcome more founders into the on-ramp of success.
Yeah. So maybe what would you say to those types of founders who might be listening here? I mean, what do founders typically get wrong about investors? What are things that they focus on too much or too little that actually matter?
So to those founders that have never done this before, I would say reach out and ask for help. There's a bunch of really awesome investors that genuinely want to help. Accelerators are fantastic places to get help. Within your local universities, there are fantastic humans that are running entrepreneurial classes, programs. Some of the schools even have investment funds. I do a lot with Cornell. Just reach out and ask for help. Nobody is born knowing how to raise venture capital, like period, hard stop. There's not even really great classes for it. So reach out, ask for help, and learn candidly before you go in the front door to that VC, right? I will also tell you, most of my colleagues will absolutely take an hour, if someone asks and works the network to a connection to a connection to a connection, and say offline, I'm not here to help you with your pitch. I'm not here to, evaluate you. I'm just going to be Maia Benson today, a mentor and a friend, and they'll help. They'll say, okay, this is the current state of your pitch. Like, here's some recommendations on what investors would ask. So they'll wear a neutral hat and really help. So, get out there, ask for help, work the networks, and everything from universities to accelerators, candidly to ex-founders. Founders are a wonderful place if you've never had to raise capital before, to ask them, like, gosh, during your fund, like, how'd you fundraise? Had you ever done this before? Like, how does it work? Like, those are all fantastic entry points to getting building a foundation.
Yeah, no, that's great. One of the messages I would have people take away from this episode is that when you are a founder just starting out, you've got to be thinking about what it is your exit could look like. Doesn't mean that you know exactly who you're going to sell to, but you're going to be thinking that these investors are putting money into you and your idea because there's a return coming through. And so I've met so many people who loved the idea of being a founder. They, had a $20 latte and a WeWork and no idea, and they're just kind of ideating, and like that was cool for them. But a WeWork pass does not a founder make. And so it's really about really finding something that people are going to want to buy eventually. Like you said, being willing to pivot and do those sorts of things.
Yeah, you have to build real market value. You have to trade some sort of value exchange, usually in the form of them paying you cash for the value you give them. That's exactly the right way. All I'll also say to founders is you can have a hypothesis of what your exit could look like. Just know your journey is going to be your journey, and that can morph and evolve and change along the way. But yes, people buy value in the market. Different types of buyers buy different types of value, right? Top line revenue, margin, tech. We talked about the different buckets, but they're buying something, right? So just because you look and sound good on social and you look and sound good, like as an entrepreneur, that's not like nearly sufficient. Like, where investors are investing in returns, right? We've got people that invested in us, right? That we've got to return their capital and then some to. So we absolutely expect real monetary yield.
Absolutely. I want to shift gears a little bit because
Mhm.
your career is so fascinating, because we've talked a little bit about the pre-seed and seed stage and what it takes to kind of suss out an idea and think through that exit. Now let's go to the other end of the spectrum. You ran Shopify Fulfillment for a number of years, and this had to have been one of the most hotly debated conversations inside of Shopify. It was, do you go out and build something? Do you end up going out and buying something? I think when you were there, the thesis was to build, and obviously they acquired Deliver, which they held for a couple of months and then sold to Flexport. Can you walk me through kind of how that decision or conversation unfolded internally, with the build or buy around fulfillment?
So really the genesis and a lot of Shopify fulfillment was actually my baby. So I think anybody that is building something within a large company, you have to know what ecosystem you're living in, with it, what culture you're living within. And so we very much we're a tech founder led company, and with a wonderful backbone of experimentation. And so in order to even get Toby's attention and $1 billion investment commitment, I basically was the first to segment Shopify's merchant base. I saw at the top of the pyramid a few merchants that were generating a whole lot of volume. Looking around the market back in 2016, 2017, of what 3PLs would even take their business, it was very few and far between, right? So you had Shipwire to San Diego, you had FBA, the likes of the ShipBobs and the ShipMonks were just literally set of slides being born. So the landscape for the emerging Gymsharks out of the UK or the Allbirds on who would take their business was really not mature. And so that was one big state of affairs. And so I kept getting pinged internally as the shipping lady from these merchants saying, Maia, which 3PLs should I use? And so the first thing I did was I built an Excel spreadsheet that basically said, like, here's a couple 3PLs you could reach out to. It was like an internal directory. So it started there. And then once these plus merchants kept pinging me enough, I basically said, why don't we run some experiments around here, right? Why don't we see, as we're learning about these problems, if we can refer them to 3PLs? So we did some kind of quiet pilots to prove out, what we were learning in the market around merchant demand, help Maia, who should I use as a 3PL? But also we started to test a little bit, like, does Shopify's plus sales team know how to listen for this? And do they know how to sell this? Meaning sell a referral, like, let me introduce you to. And so that built enough of the groundswell. And again, this is within a company where you can't just go to Toby with like this crazy idea, even though it's supported by some data. It was like, no, we've actually tried this. The other thing is some of those really smart next generation FBA 3PLs were starting to play with 2-day delivery promises. So the other thing at that moment in time for Shopify, 2016, 2017, is we had a big channels growth initiative, right? So we were partnering with all the marketplaces, et cetera, to help our merchants sell everywhere. And I remember when we partnered with Walmart, it was really exciting, but we were walking these merchants into a sell everywhere world with Walmart, and they had 2-day delivery promises. So we were setting these merchants up for failure, right? Because in order to succeed, they needed a 2-day delivery promise, and there just wasn't enough of a market landscape to help them. So some of these early partners started to test and learn with that and saw yields, saw results, right? And then we got into some other private conversations with some very big companies that saw the data and conversion firsthand. I won't name names. But the TLDR is we started to realize there was a ghost set of GMV or growth behind our merchants, that if we could give them 2-3 day delivery promises, they could realize a lot more revenue, right? So you had this lack of market competition or candidly 3PLs to even take these merchants' business. You had this ghost set of GMV sitting there. And then you had us growing into this omni-channel sell everywhere world that really created the exciting environment for us to get serious about this. And then to your point, we spent about 14 months running around the world looking at build by partner, like how do we accelerate our position in this space? And through that adventure, I've been fortunate enough to see and learn and grow up with a lot of this next generation of 3PLs. And when we landed on build, to your point, that was super exciting. And then we, started on the adventure of putting those pieces together to drive the build, both on the tech side as well as all the 4PL partners that we engaged. So, within Shopify, that was the right way. That was the culture, was to, test and learn to gain trust, and then look at, ways to accelerate, make an educated decision, and then build. And I think a couple learnings came out of that. One, I think we went out to the public too soon to let the world know we were going to build and have $1 billion investment in this space. I think that tipping point was just really, really early on in our journey, which then brought the spotlight and then a ton of expectations and then like all the rest of the dominoes.
Yeah.
And then number two, I think candidly we underestimated the time to build. So because we went out so early, and we and also, like, it's okay. Most founders, most companies might underestimate time to build. I think those two things really crunched the Shopify Fulfillment Network journey. So that teed up, what became then the accelerate our position again, opportunity to buy Harish and Deliver. And I think that chapter is its own story, meaning, I texted Harish when that happened. I said two things. I hope they let you keep your brand, and I hope they let you run this thing, right? So there was just a magic window of opportunity where Shopify Fulfillment Network had a goal of serving highly branded merchants that wanted custom packouts and branded experiences. Whereas Deliver was building for the Amazon FBA, brown box, plain tape, high velocity. And so there was a window there where you could use the brown box, plain tape world instead of merchants and volume to basically buy the transportation discounts to subsidize the highly branded world. And that's not what happened. So anyway, it's I think there's several exciting learnings in that whole journey, and that's maybe a little bit of insight.
Yeah, no, I learned a lot there. I mean, I think as the outside observer, the assumption was, oh, well, Shopify wants to take on Amazon, and so Amazon has a bunch of warehouses, and Shopify's going to have a bunch of warehouses. But what I'm hearing from you is that you guys were looking at this and saying, if our brands are going to be successful, there's literally nobody out here who can fulfill everything, and so how do we create this ecosystem? How do we go out and build that?
We were not trying to be the next Amazon. In fact, I remember when the IR team called and said, Maia, how are we going to be different than Amazon? I said, we're going to make money. Right. So we were trying to serve a different market. Right. So when Thrive Cosmetics wants custom tissue and, their own boxes, branded boxes and packaging, awesome. Let's serve that up all day, every day. So it was just, we were not trying to be out of the gate brown box, plain tape, high velocity, because that's not a lot of who our merchants were. So it was a different market that we were trying to serve. And candidly, like I said, how were we going to be different? We were going to make money.
Yeah, I love that. If hindsight's 2020, I'm sure you thought about this a lot. If you could go back to that period of time, knowing what you know now, how would you have approached the problem differently?
We probably would have been louder as a leadership team on not going out public as quickly as we did. I think that was that just changed the whole entire paradigm of, what's wonderful about venture capital for founders is it buys you air cover and time to accelerate and learn those fast failures as quickly as possible. And I think once you're a public company with this on the block publicly, then with all of the world, including reasonably folks like you saying, oh God, Shopify is going to go into the Amazon world. I think that air cover and that quiet period of time to test and learn your way to success just gets exposed. Right. So I think that going public so early on was something I think we maybe would have wanted to have been.
In other words, maybe
louder.
Only announce your results, not your intentions.
That and just be a little bit more mature along the product development path, right? To have more capabilities to then start to go public. The best world in which to go public with anything is through a merchant story, right? Have a couple of those successes under your belt where it's like, we win with merchants that look like X, and here are 2 or 3 of them that can sing the story about that proof of value.
And I'm sure you had a
we were
couple of those, right?
We were on the precipice of building those.
Okay.
Yes. So it was very, very early.
Gotcha.
Yeah.
You know, obviously most people here are not going to, like that's a fantastic example and experience that you've had. I think most people probably will not have the opportunity to be building a fulfillment network in a white space environment at a large, well-known company that's kind of really the leader in all things e-commerce. What could founders or operators take away from the Shopify decision about when to build something in-house versus when to find a partner or when to make an acquisition?
Build, buy, partner decision tree is, I think, hyper specific to any given company. So I hate to give you broad brushes here. I think what matters a lot to founder-led companies, for all those that are building that would potentially exit, is they look for other founders, right? So I think that founder to founder connection is like unbelievably powerful for anyone building for an exit. Again, this goes back to my earlier point. You got to know your buyer, right? You just got to know your buyer. So if you're selling to your company to somebody like Toby, the tech better be awesome, and the connection with the founder has got to be awesome, right? Conversely, if you're selling to a company that's optimizing for profit margins and is a different, stage in their life cycle that's on their, 20th CEO in 10 years, that's a very different optimization as a founder that you're going to position yourself as, right? So, know who your buyer is, know what they're optimizing for. And if you're a fit for that, great. If you're not, that's okay too. There'll be just find a different profile of buyer.
Yeah, that's great advice. And you've done so much advising over the years, and just I've heard really good things about people who've had the chance to take you up on that offer to learn about things, to get your perspective. What advice would you give to a founder who's really great at product, but struggles with the business building side of things?
Be really great. Know who you are. Know for all of us, know what your superpowers are and where you need help. And then where you need help. So if you're really great at product, but not so great at the commercial stuff, and that can mean a lot of things, right? Sure. So commercial stuff could be literally like, what are the market's needs? Not to mention pricing, promotion, and the 4 Ps, but know who you are, find complements to fill in where you're not whatever your superpowers are not. And I think that's where you want to start. I think great product people. So I was born into product management from an MBA lens. There are a lot of people that are born into product management from an engineering lens. Both orientations are incredibly valuable and candidly very complementary, but it's rare to meet someone that has the holistic lens of being good at both. What does the market need? How big is it? How do we price? What is that? All that, commercial wonderfulness, as well as somebody that's like, hey, I got to live in the following architecture. I got a network. I got a tech stack that looks like this. My data structure looks like this. So somebody that deeply understands the technical side of product. I think when you find the mix of both, it's a really unusual and awesome, unique skill set. So just know who you are, know which side of the fence that you live on, and then find complementary skill sets for where your strengths do not lie.
Yeah, I think there's a great deal of humility you have to have. It's interesting because you have to be a little bit arrogant to be a founder, right? To think that you can go do something that nobody else has done, and that you're worth investing in. But there's also a degree of humility here to understand and be able to say, I'm not good at this.
I don't see it as arrogance, right? I think amazing
Confidence then.
founders, it's determination.
Hmm.
It's like, I'm so sick of seeing this problem broken that I am so determined to fix it. And to your well said point, the best ones have all the humility, all the empathy, all the superpower learning skills and listening skills to zoom in into that problem and where the value exchange is, where they can make money as fast as they can. It's not about ego. It can't be, right? Empathy is a superpower. If it's about you, you're not listening. And if you're not listening, you're not solving the market's needs. So I actually have seen many amazing technologists build literally unbelievable tech and things, but it was in their own echo chamber and world, and the applicability to the market's problems was not there.
Well, it's also, if they are living in an echo chamber, they haven't built anything that they can sell, right? Because there's no way to remove the founder from the product. And so, there's these stories of people who, have something that's great, the business is doing well, and they go to sell it, and acquirers are looking at this and saying, well, your CRM is in your head. You don't really have any repeatable processes. You haven't trained anybody underneath you to be able to make decisions. So like this business is worth nothing. Like, keep running it.
Yeah. So candidly, as an investor, and candidly as a leader that hires a lot of amazing humans and talent, arrogance is like if I sense any of that, that's you're not going to get very far with me, right? Because I know building amazing companies, products, go-to-market motions, all of those beautiful things really requires you getting out of your own way and deeply attaching yourselves to what the market pain points and problems are.
Awesome. Well, I know we're coming up on time here. We've got 2 questions that we ask everybody on Build a Business Worth Buying. The first one is, what's the best example of a moat you've seen a business build?
I mean, the obvious one, and I hate to say, you've probably had this answer before, Aaron, is I think what Apple has with a hardware platform, a ecosystem for which then they gate at the hardware and software level, is just an unbelievable closed loop flywheel they've capitalized on, right? And we can see it in their valuation and market value and all that wonderful stuff. So I just controlling a full loop ecosystem at a hardware level, I think is an unbelievable moat.
Yeah, I mean, there's a reason that they're the most valuable company in the world, or most valuable company in history, honestly. That's a great
Peter Thiel has his great sentence. I think it was Peter who said, maybe it was Musk, basically said, if you can run a regulated monopoly or duopoly, that's also an unbelievable moat. So for a couple of years, I worked for a company called Pitney Bowes, and Pitney Bowes was one of 2 companies on the planet that could print the USPS postage, so mailing and shipping, right? So you have a regulation there that protects you and the 2 other people that have the licenses. And so by definition, your competitive landscape is just pushed out to the side because you've got a regulatory connection that prohibits any more competition. So those are also really powerful moats.
Regulatory capture is great if you can get it. That's awesome.
That's right.
Cool. Last question. If you had to start today, how would you go about building a business worth buying?
Well, I'm doing it. So, and I invest in it, and I'm trying to help a lot of us do it. So, I'm sorry, Aaron, what would I do?
Yeah.
I would do what we talked about probably 20 minutes ago, which is find a market problem that is massive, right? So not 10 people have it, like 100 people have it, 1,000 people have it, and just go deeply listen and learn under the covers for 6 to 8 months and understand that problem better than any other person on the planet. And once you understand it better than anyone on the planet, then start building prototypes to solve that problem with and for your eventual users. And then when you get it to a point where it starts to drive a little bit of value for that customer, then open a dialogue with them on how much this problem is worth to them. And you can be smart about it along the way. So as you found a really big problem and you're working with your customers to build out a solution, along the way you can have a conversation, right? Is this a $10,000 a month problem? Is this a $100,000 a month problem? Just order of magnitude. All this time that you're spending with me, how much is it going to be worth to you? I'm not quoting you anything. I'm not going to charge you anything, but just get an order of magnitude into how much this problem and pain point is worth to them. Do they quantify it in terms of heads, right? Is your tech replacing human heads? Are they talking about it in terms of accelerating their market valuation, right? So now they can grow faster, they can capture more revenue and margin faster. So anyway, understand the trade of value and what it gives that company that you're serving.
That's great advice. Today you're at FlavorCloud. We haven't talked much about FlavorCloud. Why don't you define how FlavorCloud is changing the cross-border game today? And then I'd love to understand if people want to learn more about FlavorCloud or get in contact with you, what's the right way to do it?
I fell backwards into this cross-border crazy world in 2013. So I think we're coming up on 13 years doing this. We're the first ever platform that powers D2C, so parcel, and B2B up through pallets, stuff, orders around the globe, anywhere to anywhere, 220 countries, anywhere to anywhere. So not just US outbound, not just UK outbound, blah. With guaranteed landed costs, so no surprises on what duties and taxes are going to be, and full outsourced compliance risk, right? So we take importer of record and a lot of other boring, noisy customs and compliance stuff. We take all of that off merchants' plates. We handle all import tax. We handle, where it's required sales tax compliance in countries. So just the headache of moving stuff around the planet is really what we focus on doing and making easy.
Sounds good. Yeah.
And find us at flavor.cloud.com. You can find me at Maia at flavor.cloud.com. And looking forward to engaging with anybody that wants to talk about all the tariff stuff that you and I are living through, the whole world's living through, Aaron. So just please reach out. We'd love to help.
Yeah, on the tariff side, I've been joking around. This feels like early COVID all over again, where the world is shutting down. You're not quite sure what's going on. News is changing hour by hour. You're making a bunch of plans that you throw away later on. So it's been a fun time to be in supply chain.
You're right. It's as volatile as COVID felt in the early days. I think what's different is this is like self-imposed, right?
Yes.
So, but listen, at the end of the day, this cross-border stuff is hard. There's a deep moat here of domain expertise and navigating through it. So, as merchants and brands, please know if you're doing it wrong, you're taking on importer of record risk, which means jail time, banned from being, importing into countries, or significant financial penalties. So call us if you don't want to get it wrong and don't want to leave yourself exposed.
Most people don't look good in orange.
I agree. Let's avoid what any of those colors. Yes.
Well, great. Well, Maia, this has been fantastic. I really appreciate it. And we'll have you on again sometime soon.
Aaron, so great to see you. Thanks so much for the dialogue.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.